Hello AP Econ students, this is Ms. Haley and welcome back to AP Macro Flip videos. Today we're going to compare fiscal and monetary policy. So today's video is a slight review, but then also comparison and evaluation, looking at both when the government increases or decreases spending, increases or decreases taxes, and when central banks either buy or sell bonds, how are they guarding against inflation or recession? What are the tools we want to remember that can be used by each? What are the spending multipliers, the money multiplier, now the tax multiplier that can be used by each? And then what are the shortcomings of both policies? And so to get all of this information in one place, we can see that contractionary policy, whether it's from the government or from the central bank, the goal of contractionary policy is always to decrease AD, have lower price levels, lower output. And then expansionary policy, whether it's coming from the Federal Reserve or the US government, is always trying to increase AD. So have increasing price levels and increasing amount of output. And when we want to determine how much specifically a government should increase their spending, or what quantity or size of bonds that the central bank should buy or sell, we want to use the two multipliers that we know. So either the spending multiplier, 1 over MPS, or the money multiplier, 1 over RR. And this week we're going to add one extra multiplier, so the tax multiplier, that if the Jordanian government increases taxes by $1 million, that how is that going to decrease consumer spending or decrease spending overall and AD overall in an economy? And so we would use the tax multiplier, which is MPC over MPS. So now that we have all three of these tools, we will apply them in class. And we want to think about, even though we know expansionary and contractionary policy and the numbers we can use to calculate those changes, what are the shortcomings? And so I won't spend too much time because you should have this in your notes, but we can remember that fiscal policy has three shortcomings. That fiscal policy isn't immediate, there are time lags in its recognition, implementation, and impact. Fiscal policy also could create crowding out, saying that government spending can actually take away consumer spending or investment spending. And then saving shifts, that when a government gives more disposable income to their constituents, to their people within their economy, people might actually save the money instead of spending it. Now what we're going to delve into on the next slide are these two shortcomings of monetary policy. That monetary policy in the long run only adds or detracts price levels, that there's an increase or decrease in price levels, and there isn't a permanent change in output. And that monetary policy, sometimes even in the short run, doesn't increase output, only has changing price levels, and this short-term shortcoming could come from businesses actually reacting to and expecting the coming inflation. And so what we're going to talk even more about in class, but we can look at right now, are these long-term and then short-term shortcomings of monetary policy. That in the long run, we know that even if we have an increase in AD, expansionary monetary policy coming from increased money supply, that we aren't going to have a new long-run aggregate supply, that in the long run, when wages are flexible, that they've changed based on the price level, that we would shift back to our original long-run aggregate supply output level. And then if businesses are predicting that there's going to be inflation, businesses want to change their product price, because if they're predicting monetary policy is going to be expansionary, they are going to see very soon their input prices, whether that be oil, rent, the actual items that make up their product, are going to now be so much more expensive, and the wages are going to rise as well. They're going to have to pay their workers more. Those businesses might preemptively shift their short-run aggregate supply to the left. They might actually decrease their amount of output because they predict that in the future they're going to see this rising price level. So whether it's in the long run or sometimes in the short run, with monetary policy, we aren't guaranteed even a short-run increase in output. So thank you all for today's video, and tune in for part 2 of video 12, where we're going to connect the Phillips curve to fiscal and monetary policy.